to Ajanta Pharma Q4FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Yogesh Agrawal, Managing Director of Ajanta Pharma Limited. Thank you, and over to you, sir.
Thank you. Good evening and welcome to all of you. With me I have Mr. Rajesh Agrawal, our Joint Managing Director, and Arvind Agrawal, our CFO. I'm glad to inform you that financial year 2022, we have returned rupees 436 crores to the shareholders against rupees 251 crore in the financial year 2021 in the form of dividend and buyback. So this reiterates our commitment to the shareholders to return the free cash flow in excess of the business requirements. Further, the Board of Directors have approved in today's meeting issue of bonus shares in the ratio of 1 share for every 2 shares held, subject to the approval of the shareholders. Coming to the results, they are already there with you, and I'm happy to share with you the year has witnessed a strong growth momentum across all our major markets. I will take you through the business-wise performance during the quarter and for the year, along with comparison of previous year for the same periods. Let's start with the emerging markets branded generic business. First, I'll touch upon the Asia. During the quarter, sales was 263 crores against 172, posting a 50% healthy growth. And for the whole year, the sales was 813 crores against previous year 712 crores, posting a growth of 14%. The smart recovery in the growth was in line with our expectation and is the result of our continued effort to strengthen our brands in these markets. Coming to Africa, during the quarter, the sale was 136 crores against 99 crores, posting a healthy growth of 37%. And for the full year, the sale was 587 crores against 413 crores, posting 42% growth. Asia and Africa put together contributed to 43% of the total revenue for the financial year 2022. Our exports to these markets were rupees 398 crores against 273 crores, a growth of 46% during the quarter, and rupees 1,400 crores against 1,124 crores, a growth of 25% during the year. Moving to the US generics, US contributed 21% to the total revenue for the financial year 2022. We registered the sales of 168 crores against 173 crores, posting 3% degrowth during the quarter. For the financial year 2022, the sales were 696 crores against 637 crores, posting 9% growth. Lower growth in Q4 and financial year 2022 was due to increased competitive intensity, leading to higher than anticipated price erosions on the base business. During financial year 2022, we launched 3 new products and filed 8 ANDAs. We received 2 final and 1 tentative approval, and 20 ANDAs are awaiting approval with US FDA. We are poised to file 10 to 12 ANDAs in financial year 2023. Coming to the Africa institution business, this business contributed 6% in total revenue for financial year 2022. We registered sales of 50 crores against 80 crores, posting a degrowth of 38% during the quarter, and 206 crores against 271, posting a degrowth of 24% for the financial year 2022. As we have mentioned earlier, the institution business remains unpredictable. With this, now I hand over to Mr. Rajesh Agrawal, our Joint Managing Director, who will take you through the India business. Thank you, and over to you, Rajesh.
Thank you very much. Good evening to all of you. Let me now discuss some of the key highlights of the India business with you. India business contributed 30% in the total revenue for FY 2022. Sales stood at rupees 245 crores against rupees 218 crore, posting a growth of 13% during the quarter, and was at rupees 982 crores against rupees 813 crore, again posting a healthy growth of 21% for FY 2022. This includes sales from trade generics of rupees 30 crores during the quarter and rupees 117 crores for the whole year FY 2022. We have launched 16 new products in FY 2022 with 4 first-to-market products in the country. Our performance has been satisfactory, which was on the back of new product launches, market share gain, and price increase. As per IQVIA, MAC March 2022, we have posted a healthy growth in all therapeutic segments and exceeded industry growth across therapies. We have 3 of our brands appearing in the top 500 in IPM now. With this, I would like to hand over to Arvind Agrawal, CFO, to take you through the financial performance. Thank you, and over to you, Arvind.
Thank you very much. Good evening to all of you, and warm welcome to this earnings call. For ease of discussion, we will look at the consolidated financials and provide year-on-year comparison. You will understand that FY 2021 witnessed higher profitability due to COVID impact. Hence, FY 2022 comparison with previous year will not be apple-to-apple comparison. Let me take you through key financial highlights for the quarter and full year. It was an excellent quarter and year with 15% growth in revenue for the Q4 and 16% for the FY 2022. Total revenue stood at rupees 870 crores against rupees 757 crores in Q4 and is at rupees 3341 crores against 2890 crores in FY 22. EBITDA for the quarter stood at 207 crores against rupees 259 crores. For FY 2022, it was 929 crores against rupees 999 crores. EBITDA was 24% for Q4 and 28% for FY 22, lower than previous year due to normalized expenses on both R&D and marketing after the post-COVID, and increase in input costs and trade expenses. During the quarter, PAT was at rupees 151 crores against rupees 159 crores, down 5%, and for FY 22, it stood at 713 crores against 654 crores, up 9% due to reasons mentioned earlier. PAT for the year is at healthy 21%. Material cost was higher in Q4 and FY 22 due to increase in API prices and US price erosion. We are still witnessing upward trend in few API prices, which may impact gross margins going forward. R&D expenses was at rupees 59 crores against rupees 39 crores last year for the quarter, and rupees 204 crores and 139 crores for the whole year. R&D expenses stood at 6% of revenue, which will continue at this level going forward. Other expenses reached normalcy and all the activities are at pre-COVID level. With our continued focus on branded generic business, we will be allocating higher resources on product registrations, team, and launch of new products. Other income stood at 116 crores in FY 22, mainly contributed by forex gain of rupees 73 crores. Income tax stood at 22% for FY 22 against 27% in FY 21 and expected to move slightly higher going forward with some of the facilities phasing out their tax exemption. We incurred capex of rupees 154 crores in FY 22. Our net fixed asset turnover has improved to 2 times in FY 22 compared to 1.8 times in FY 2021. Capex, including maintenance capex for FY 2023, is estimated to be about 200 crores. We have reduced the inventory levels to 88 days against 98 days in previous year, with supply chain returning to normalcy. Receivable levels increased to 113 crore days in March 22 from 95 days in previous year, but they are all in normal routine nature. With these highlights, I open the floor for the question and answer. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. So, especially on domestic formulation segment, given that this year had a robust growth, partly on account of the low base of last year.
I'm sorry,
so going to
Mr. Manudhane, but their voice is breaking, sir.
Is this better?
Yes, please go ahead.
Yeah, just on domestic formulation piece where the growth was quite robust for FY22, and at the same time, given that you'll have the NLEM-linked price hike upcoming in FY23, so what kind of growth can be anticipated in this segment?
Overall, for domestic, we are looking at mid-teens, and more importantly, our ambition is to grow faster than the market and the sub-therapeutic segments. With mid-teens growth, I think we should be growing faster than that.
Understood.
Yes.
And secondly, on the gross margin front, where we have seen a sharp dip both quarter-on-quarter as well as year-on-year basis. So how do you see this raw material pressure in the near term, maybe like in over next 3 to 6 months?
Tushar, I think here I would like to explain, this quarter, if you see, the COGS is about 28%. Right?
Right.
Now, out of this 28%, 1.5% is one-time charge. We had sent one product to US with the expectation of good flu season last year, 2 years ago, and now it is nearing expiry, so we have written it off in this quarter. So that is one-time impact, which is about 1.5%. And there is another 1.5% impact because of the price erosion in the US. So total 3% of the this higher cost of COGS is only because of this reason. 1.5% is one time, so it is not going to be there. Another 1.5% will remain because that is the price erosion impact. But that we are expecting that from going forward, we should be able to increase our branded business component higher in the future coming years, because of which we should be able to recover. So our guidance of that 25% overall COGS is something which remains with 75% gross margin.
Understood. Okay, that helps. Thanks a lot.
Thank you. The next question is from the line of Rashmi Sancheti from Dolat Capital. Please go ahead.
Yeah, thank you for the opportunity. Sir, again on gross margins, you said 1.5% impact comes from the price erosion in the US and 1.5% charge on the product charges, and the remaining everything comes from the high raw material prices?
Yes, you are absolutely right.
So that means the impact is quite higher, right?
You are right.
Yeah. So what I want to understand, despite a very strong growth in the branded business segment in Asia as well as Africa and India, where normally the gross margins are pretty high, this is not able to offset it?
It will get offset, as I said, again just now, that it will get offset, but the numbers have to get in for that purpose, because see, for the quarter it will have a major impact. But once you are taking the whole year, you can see that our still the whole year margin is still 75%, in spite of 28% in the quarter. So that is something which definitely has balanced out.
So if I just reduce 1.5% from quarter four's, the raw material impact, the rest can be the new base for quarter one FY23 and quarter two FY23. Or we should see raw material cost which is reported for entire FY22.
Yeah, I think that would be the correct way to look at it. Correct. The whole year normalizes 25%, so which offsets the one-time impact of 1.5% of the true product write-off, and also factors in the price erosion. So going forward, 25% in the current visibility what we have on the raw material packing bundle prices is what we are looking for the next year.
Okay. And sir, how much is the price erosion we have seen in FY22 versus FY21 in the US market?
It's been quite high. Traditionally, almost been to the tune of 18% plus minus.
Okay. And any expectation whether it would soften down in FY23, or you believe that it would still remain in double digits?
No, we believe that it should now again normalize to the 8 to 10% price erosion going forward.
8 to 10%, okay. And sir, normally our run rate for product launches are around 5 to 6 every year. But this year we have just launched 3 products only during the year in the US market. So what is the reason behind that, and what are we guiding for FY23 and 24? And the next question is that, is this kind of growth which we have seen in both Asia branded and Africa branded, we will be able to sustain it, or this is something that we are seeing from one-off supplies?
So 2 parts. Let me take the US part first. So in the US, the filings, the approval, the launches could not be done because there are a number of products under approval with the FDA. And as you are aware, the FDA has still not resumed the regular inspections. They are still doing the inspections either for cause or mission critical. So we've been pursuing with the FDA, and the FDA stand still remains that they have not opened the regular overseas inspections. Until the time that doesn't resume, our number of ANDAs which are awaiting approval doesn't get approval. And this scenario is not only to Ajanta. I think this is across all the companies like us who are waiting for the FDA to start inspecting. And as that starts to happen, we will again hopefully come back to the launches of 5 to 8 products per year. So that was the first part on the US. And second, on the branded generic, we've been guiding that because of the headwinds which we see in the US market, larger focus, attention, resources are being diverted towards the branded generic business in India and the emerging market. And you've seen the growth which we have posted in the current year. Going forward also, we do not give the guidances region-wise, but we believe that on a blended basis, we should be able to deliver the mid-teens to high-teens growth in this market.
Okay. Okay, sir. Thank you very much. That's it from my side.
Sure.
Thank you. The next question is from the line of Kunal Randeria from Edelweiss. Please go ahead.
Good evening, and thanks for giving me this opportunity. Sir, is it fair to assume that the kind of price erosion that you mentioned is maybe specific to Ajanta, perhaps 2 or 3 products? Because some of your peers who are operating in the US, they have been saying that the price erosion has been fairly stable now for the last 2 quarters.
Sorry to interrupt, sir, but we cannot hear you. Your voice is breaking. We are unable to hear you.
Hello. Hello.
Yes, sir. Please go ahead.
Can you hear me now?
Yes, sir.
Okay. So I am saying, in general, I think most companies have seen aggressive price erosions. And I think most companies in their earning calls or otherwise, they have mentioned that the price erosions have been twice of what we've witnessed in the normal years. So I think, and again, company to company, it may vary depending on the product portfolio. But in general, our take is that the price erosions have been fairly aggressive, but which are stabilizing now.
Sure, sir. And just to take this point forward, so these kind of erosion obviously cannot be sustainable, right? So at some levels, the companies will have to start downsizing their portfolios. So how far away do you think the industry is from? Because once they start downsizing, I guess the erosion should also then start coming down.
That's a good question. We are not at that inflection point. Case-to-case basis, product to product, they keep getting added and dropped. But I don't think on a materialistic basis where I can say that there'll be any drop-off of any products.
Sure, sir. And sir, when I look at the balance sheet, receivables have gone up quite sharply. So is there any kind of pressure from emerging markets?
For what?
Your receivables.
So receivables have gone back to the pre-COVID levels. If you see pre-COVID levels also, your receivables around the same time. I think during the COVID times, there was a lot of efficiency which was coming, including expenses. Yeah. So I think this is the normal level. There is no exceptional elevated levels there.
Sure, it was 111 in the 2020. Now it is 113. So we are at the same level.
Got it, sir. And just lastly, sir, product Chantix that we have discussed in the past, I mean, is the approval held back because of plant inspection or some other reason?
No, unfortunately, there are different components to it. So I think we'll not be able to give you a product-specific insight. At the best, we can say that it is still under review with the FDA, and we are hoping for the earlier approval than later.
Sure, sir. And just one more, if I can. So you have over 320 crores of cash on your books. Just wondering, are you open to acquisitions? And if so, what kind of, company or brands do you think could fit into your company?
Yes, I think we are looking at the brand acquisition for quite some time now. And we are in the market. Every investment banker is aware that we are looking for the brands. Our preference definitely will be India because we understand it better way, and also we feel that here we can add value by acquiring the brands. So we are open for it. We are looking at all the deals which are happening in the market, but we are still not getting the brands for valuation which we feel is right. So that is where I think we are waiting, but otherwise we are definitely open.
Got it, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Abdul Kader Puranwala from Elara Capital. Please go ahead.
Yeah, hi, sir. So thank you for the opportunity. So my first question is with regards to the field force rationalization what we had done earlier. So are we entirely done with it at 2,800, or is there any further scope for us to rationalize this further?
Rationalizing of the field force?
Yeah.
Yes, we are completely done with that, and we don't see the scope or the need to reduce the field force any further. As a matter of fact, going forward, as and when we feel it is important and the productivity increases, then we will again come back in the mode of adding medical representatives wherever necessary.
Sure, sir. And so my next question is on the margin front. So wherein you said the gross margins would be close to 75% ahead. So I just wanted to hear your brief commentary on how it would look on EBITDA and considering that some bit of an operating leverage would also be there in the business because of the Guwahati plant and the utilization level improving. So if you could guide us something on the EBITDA margin front as well would be little helpful.
I think we should be able to retain the EBITDA margin of the current year. For the whole year, we have done about 28%. I think we should, going forward also, we should be able to get this kind of EBITDA margin, maintain this margin.
Sure, sir. And just a final question, if I may. So in your earlier commentaries, you have mentioned that nearly 50 to 60% of your branded generic portfolio is under some sort of a price restriction. So now that the prices of your raw materials are increasing, so how soon can this be passed to the customers within the geographies of India, Asia, and Africa?
For India, as and how we have the eligibility to increase the price based on the NPPA guidelines that we have. So we are able to comfortably pass that on. And of course, as you have seen, all the NLEM products, also there has been an increase of 10.5% in the last year because of the WPI linkage. So that also we have taken for all the brands that were under NLEM. And our NLEM brand portfolio is not more than 20% in the domestic. And so it is for the international markets also, as in how we have the opportunity, we are able to pass on the price increases, but at the same time, we take a very granular approach and look at each brand and the other competitors' pricing also, because we don't want to be completely out of range. So it's a very meticulous process that we follow and then take a decision based on that.
Any color on which months, or which quarters where exactly the price hikes have been taken earlier, or you would like to take a call going ahead as well?
For NLEM brands in domestic, it happens every year in April as per the NLEM and NPPA guidelines. That's common to the whole industry. So we have taken it last month, which will start to impact us maybe May or June as the inventory exhausts of the old pricing. And for the other brands, it is based on a yearly cycle. And again, as I said, it's hard to tell you on the company-wide basis because every brand may have a different cycle and also different competitive pressures. And the competitor MRP is also equally important for us to make a decision.
Got it, sir. Thank you so much.
Yeah, thank you.
Thank you. The next question is from the line of Ankit Pandya from InCred Asset Management. Please go ahead.
I hear you where you said that for the non-NLEM portfolio, this is an annual exercise, and you'll have to wait to see how the competitor behaves. But the costs, which is the API cost, etc., has gone up equally for you and your competitor. And as we understand, Ajanta is one of the leading brands in most of the therapies that you are present in. So in majority of the cases, it is the leader who initiates the price increase and the followers follow. So you would already have a fair estimate as to what kind of price increase you'll be able to take in 80% of your India portfolio, which is not covered by NLEM. So would you like to guide us as to what percentage price increase you will be able to take?
So you're right in a way that wherever we have market leadership, we are in a position to command the pricing. But at the same time, we are also price leaders in most of the molecules that we have been first to launch or where we hold significant market share. So we are already at the price point where competitors are a little bit lower than us or maybe at max along with us. So what happens is we will have to evaluate based on the indirect competition also. But the maximum, to answer your second question, the maximum price increase that we can take is 10% for the whole year on any given brand as per the NLEM NPPA. And NLEM is of course linked to WPI, and NPPA guidelines restrict us to take not more than 10%. So that's an exercise that we undertake, and then we increase the prices as and how we find it appropriate.
I understand. Thanks for the response. Secondly, when it comes to, let's say, Asia or your Africa branded sales, would the dynamics be similar there? I know the NLEM concept doesn't apply there, but and in some cases they dictate prices. But what kind of price increase will you be able to take in your branded markets?
For Asia, some of the countries actually follow a similar method like NLEM, like Philippines has a list of essential medicine, and there also they have, but of course we don't have any of the brands in that particular list. But we are able to pass on the pricing because, as you know, the inflationary price pressures are being faced by all the competitors across the globe. So this is a common practice now in the last 6 months, 9 months that we are seeing that companies are very comfortable taking the price increases across the globe in every segment, every country. So we are also doing the same. And as I explained earlier, we take a very, very meticulous and on-the-ground approach and then look at each brand and then take the price increases.
So at a bucket level, let's say on the Asia business, would the price increase be in high single digits or low single digit or low double digit? Because the cost inflation clearly reflects it's more than that.
So I think let's look at the company level only. That is a better way. We don't give out the margins on a region-wise basis. So as we said, for the current quarter, the 3% extra cost which we are seeing against our typical 24%, or we've added 25%, we're seeing 28%. So what we said is 1.5% is because of the one-time inventory write-off, and 1.5% is because of the price erosion. So if you remove that 3%, then we are at 125. The next year, what we are saying is that going forward, this 1.5% price erosion is here to stay, but we are going to recover this by increase of the business from the branded generic business, which also includes the price increases, which will have a higher margin. So this is how our plan is to recover this 1.5%, and we are giving a guidance of 25% gross margin, 75% gross margin for the whole company. I think it will be too difficult and not possible for us to give you a region-wise price increases and the timelines on when it's going to happen. It may not be relevant also to go so granular.
Fair enough. Just one last question. So out of your total COGS, let's say your total COGS is 100 rupees, how much is the API cost and how much is the cost of formulation? I understand you also buy finished goods for some businesses. So if you could give us a rough split, how much is your finished good purchase, how much is formulation cost, and how much is purchase of API and other key starting material?
That's a good question. I don't know if I have the figures with me. Do we have the figures?
Yes.
Yeah, go ahead.
The purchase of stock in trade is about 136 crores out of the total material cost of about 832 crores. So we are talking about 20%, 15%, around 15 to 16% of the total material cost which is being purchased directly. They are called traded goods. So that is the component. Balance everything is with the in-house material, APIs and packing material and consumables which are going to be consumed there.
Yes, so Arvind, how much is the out of the balance 700 crores, how much is our third-party purchase of API or raw material? If you could just zoom into that number a bit, because that is
we purchase entire API from third party.
Exactly. So the 700 crores would include cost.
As I said, out of 832 crores of total cost for the year, 136 is for the direct purchase from the third party, finished goods.
Formulation.
So out of the balance 700, there will be some cost of conversion of API to raw material, right? And some cost of just...
No. It is only raw material and packing material and consumables. The manufacturing cost is in the other expenses.
Other expenses, the power and fuel and all that. Okay.
Yeah.
So 700 entirely is basically third party kitchen.
Yeah.
Got it.
Yeah.
Got it. Okay, sir. This is helpful. Thank you.
Yeah. Thank you.
Thank you. The next question is from the line of Bino Pathiparampil from InCred Capital. Please go ahead.
Hi, thank you. Just a couple of questions from my side. First, just a follow-up on Chantix. I can see there are some tentative approvals on the US FDA website, whereas I don't see you have a tentative approval. So would you have to wait for those guys to launch the product before you launch, or you think you can go along with them on day one if you get approval in time?
Unfortunately, I'm not able to give you a more detailed answer on this. There are different components associated with this product. We are these are many touch points, which one is Pfizer, the exclusivity, the FDA approval. So I think I'll have a limitation in giving you more visibility on this product.
Okay. And just have you done any settlement yet or no?
Yes. We have the raw materials, packing materials ready with us. So the day we get the product approval, within 60 days, we'll be able to reach the inventories to the US market. The good part about this is the Pfizer has come back, Apotex, I think, ramped up the thing. So earlier, I'm not sure Apotex or some other company, I think Par. So the good part is that the market, which was at risk of melting or not becoming non-existent, is back up again. So that's the good news because unit-wise the market is again back to the pre-nitrosamine challenges. So for any new generics which are coming in, there'll be a bigger pie from which they can take a share.
Okay. I guess Endo is the one who has launched what you mentioned, right?
Right, yeah.
Okay. And do you have any sort of settlement with the Pfizer yet or that's open?
As I said, I'll have some limitations in giving you visibility on this. Some matters are confidentiality agreements, subsidies and prejudice.
Okay, no problem. Thank you. And just another question about the Africa institutional business. What's the outlook for coming year?
We continue to give the guidance of the flattish nature of what we have done current year. We should be able to do that kind of business next year also.
Okay, great. Thank you very much.
Yeah.
Thank you. The next question is from the line of Alisha Mahavla from Envision Capital. Please go ahead.
Hi, sir. Good evening, and thank you for taking my question. So my question was with respect to the branded business in the emerging markets. We've obviously seen very strong growth this year, and we're talking about achieving a mid to high teens growth on top of this. Is my understanding correct?
That's correct, yeah.
And can you break down into what will be the growth drivers, or why are we expecting this business to achieve such high growth on such a high base?
The growth drivers are the same as what they are. I think new brand launches, gain of market share and price increases. And we are confident that we will, and also we are undertaking expansion wherever we feel it is appropriate in terms of adding the numbers of the medical representatives in every country. So this is what will drive the growth, and we are reasonably confident that we should be able to achieve these objectives. Yeah.
Okay, sure. So, and with respect to our margins, we just called out earlier that we're expecting it to be at about 28% level, but post with improved utilization at Guwahati, we were expecting this to be closer to 30%. So is there a reason why we're expecting we won't be closer to the 30% mark in the near term?
Basically, I think the price erosion in the US is impacting us to some extent. Plus, also we are now investing on the next phase of growth for the next 4 to 5 years by investing more on the product registrations and for the people, etc. So because of that, it is a conscious call that we are taking. We would like to really work on that. We are talking about higher resources allocation for the branded generic business. So because of that, we expect that it should be somewhere around 28%.
Okay, thank you.
So I think this, just to add on what your question was, the fact, as we said, that we are adding more resources, attention, focus on the branded generic business. So that is what is increasing the expenses also, because we are adding people, we are increasing the promotion. So all this is adding and some R&D expenditure also, because we are putting a lot of trust on developing new products, filing the registration. So this is kind of slightly elevating the expenses, resulting into still be able to maintain a 28% EBITDA, which is still a very healthy EBITDA to have. So this is primarily looking forward for next 3 to 5 years growth.
Okay, thank you.
Yeah.
Thank you. Before we take the next question, reminder to the participants, to ask a question, please press star and 1. The next question is from the line of Nitin Gosar from Invesco. Please go ahead.
Hi. Two questions. On R&D, R&D now is around 200 crores for the year. Dollar denominated number could be around $27 million. Could you help me understand where are we investing predominant growth? If it's coming from branded generics, then why the investment is so high for R&D?
So, yeah, almost I think it is 50-55% is for the regulated markets, US, and around 45% odd is for the India and the emerging markets.
What Nitin, I think you are trying to ask is that the R&D expenditure is high according to you in terms of the branded generic business. That's what you are trying to say, right?
Or is this compared to the previous year?
Yes.
And what should we consider as a
last year is not a like-to-like comparison.
Yes. Because previous year, you can see that because of COVID, the R&D was almost not working for 6 months. So that is why the expenditure was lower. But if you see the year before, I think our expenditure was almost about 140 crores. So I think we are talking about consistently investing on the new product registrations, new product development, even for the emerging markets and India also.
Just to add to that, R&D is what has given us the edge to be able to launch all the new brands in India as well as in the international markets. And most of these formulations we have been the first. So in that sense, we have been investing reasonable amounts in the R&D, which has helped us to gain a competitive advantage in the market.
Okay. And what should be the ballpark understanding on US market R&D investment, like $13-14 million, and we're doing filing of around 10 to 12 a year? How should we gauge the investment ratio? Is it high, moderate according to you?
So we have titrated the ANDA filing, and we are looking to file 10 to 12. Current year we ended up filing 8, but there are some products which got skewed towards the end of the year, and we are expecting a larger filing in the Q1. So next year it could be instead of 10 to 12, it could be higher than that also. So I think in terms of percentage, as I said, you can estimate around 55% to be for the US regulated market of the R&D spend, and 45 is for India and the emerging market.
Okay. Second question is with regard to working capital. Arvindji, you mentioned we are going back to the pre-COVID days on debtor days. But if I were to take combination of inventory, debtors, and payables, we have gone to almost a level where we have not seen this company for last 7-8 years. Our understanding of earlier 5 years was anywhere between 3 to 4 months, and now we are surpassing 5 months on inventory on working capital.
Yeah.
What are we trying to do out here? Why is it going up, and what can result it to come down ultimately?
No, for the inventory, slightly you've seen last year we had ramped it up because of the COVID uncertainties, and that was a conscious call to taken not to be stocked out of the market, which we are now pruning down slowly. And currently you've seen from 98 is already come down to 88 days. And maybe there is some scope to taper it down further. Number one. Number two, there are some inventories which got built up because of the new product launches expected for the US market. That also got added up, and we didn't get the ANDA approval, so that also slightly elevated. I think other than that, there is no concern on the receivables. I think it is 110. Maybe at the end of the quarter, the billing occurred, which is resulting into slightly higher outstanding. But there is nothing to be concerned about. I think it's a very normal level.
So point taken. Only if I were to see numbers in last 4 years, it's moved from 120 days to 128, then 145, and now 160.
Working capital.
Total working capital.
I think Nitinji, I think I mentioned last year also the same thing. I again repeat that the US business has got definitely higher inventory and higher receivables. So that is something which we explained last time also, that is the cycle which is there. in that particular market. And we strategically have placed higher inventory for that particular market. Plus also the cycle there is little longer because of the chargebacks, etc., which I explained last time. So if you are comparing 4 years back, then our US business was very small. Now the US business is higher. So naturally, to that extent, it has gone up.
Okay. So we should consider this number as a steady state number, 160 days, or it should?
Yeah, I think this is a steady state number. Now, there may be, as MD said, there may be some scope for improvement, but nothing major really.
Okay, got it, sir. Thank you.
Thank you. The next question is from the line of Harsh Beria, an individual investor. Please go ahead.
Hi, am I audible?
Yes, you are audible. Please go ahead.
Hi. Congrats for the good set of numbers. I was seeing on the FDA website that Ajanta got an ANDA approval for generic Distolic in March. And I also remember, like last time, you guys said that we cannot get approvals unless FDA inspects our facilities. Does that mean there was some kind of inspection at our facility?
No, there was no inspection. So it is the FDA's call, which they feel under the review that they can approve the products without having to go for the factory inspection. So it's purely during the review cycle, the call is taken by the FDA. So there could be approvals which may be received without the inspection also. And there are a lot which get tied up with the inspection. So to answer your question, no, we've not had the inspection for our facilities from the FDA.
Okay. My last question is about domestic trade generics. I've seen that this business has scaled very well. I think it's already up to 170 crore levels. What's Ajanta's strategy in this business division?
The overall strategy in this is we are trying to focus more on specialty as against just general product range that is there. And we have gained a tremendous acceptance with the trade and also with the pharmacists, chemists, and the patients. And that is what has given us the traction and the growth that you see crossing 100 crores in this year.
And are the gross margins similar to the branded generics in the trade generics division?
No, gross margins are much lower, as you can expect. They are much lower, but yet they are lucrative enough for us to be able to operate in it.
Okay. Can you give like a broad range of gross margins that this division might be making? Is it similar to the OTC gross margins of 55-60%?
No, we don't give the individual gross margins for the division-wise.
I understand. Thanks for taking my question. That's it from my side.
Thank you.
Thank you. The next question is from the line of Surajit Pal from BOB Capital Markets. Please go ahead.
Hi. Thanks for taking my question. As you have mentioned, is that you are also getting into non-pharma business in API segment. Could you throw some light to your plan and how aggressive you are into getting into that, and what could be the approximate revenue going forward?
No, I think there is some misunderstanding. We are not getting into non-pharma or in API business at all. We are very firmly entrenched into formulations, and that is what our core strength is, and we will like to build on that itself.
Okay. And do you think that current level of marketing expenditure or the other overhead cost will maintain at the same level, or do you expect that there will be growth further?
No, I think it will be at the same level, barring the normal inflation. Definitely that will creep in, but otherwise it will be almost at the same level.
Okay. Thank you.
Thank you.
Thank you. Participants who wishes to ask a question may press star and 1 now. Anyone who wishes to ask a question may press star and 1. As there are no further questions, I would now like to hand the conference over to Mr. Yogesh Agrawal for closing comments.
I just want to thank all of you for joining this call. If there are any questions which left unanswered today, please feel free to reach out to our investor relations team. Once again, thank you for joining us today.
Thank you, everybody.
Thank you.
Thank you. On behalf of Ajanta Pharma, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.